Picture this. You check silver and it's down so fast your brain assumes your app is glitching. You refresh and it's even lower. $10 gone in minutes. Then, before you can even finish the sentence, what just happened, it flips green like nothing happened at all. That kind of move isn't just volatility. It's a signal that something in the plumbing snapped, even if the headlines haven't caught up yet. If you want more calm, story-style breakdowns that explain what these moves actually mean for everyday people in the US, take 1 second to subscribe. I keep it simple, I focus on what matters, and I don't assume you want a bunch of confusing Wall Street vocabulary. Subscribing also helps you catch the next update while the story is still unfolding. Now, let's slow this down because a $10 drop in snap-rebound isn't random. It usually happens when three things collide at the same time: leverage, thin liquidity, and crowded positioning. And the reason it feels so violent in silver is because silver is one of those markets that can look calm for weeks, then move like it's trying to compress a month of price action into 1 hour. Here's the first piece most people miss. When you see the silver price moving on the screen, you're usually watching a paper-driven reference market. Futures and options can trade huge volume without any physical bars moving anywhere. That's not automatically bad. Paper markets provide liquidity, but it does mean price can swing hard when traders are forced to react. Physical silver can't move at that speed. Mines don't speed up. Refineries don't suddenly double output. Trucks don't teleport. So when paper markets get hit with a fast liquidation wave, the screen price can plunge even if physical demand hasn't changed much at all. This is why a crash and reversal can happen in the same day. The first move is often paper panic. The second move is often the market realizing the first move went too far, too fast, and now positioning has to be rebuilt at higher prices because the underlying demand didn't disappear. So what could cause the first leg, the sudden $10 dump? One common trigger is forced selling from leveraged positions. In silver, a lot of exposure is held with leverage, especially through futures. When price breaks a key level, stops get hit. When stops get hit, selling becomes automatic. When selling becomes automatic, the move accelerates. And if the drop is fast enough, it can trigger margin pressure, where traders have to add cash or reduce positions right now, not later. That's when you get that ugly waterfall candle that looks like the market is falling through a trapdoor. But here's the twist that makes this story worth watching all the way through. The rebound often tells you more than the crash, because lots of markets can fall on panic. Not every market can reverse sharply and hold buyers after a violent drop. When silver does that, it can mean the selling was more about forced liquidation than true nobody wants silver. Think of it like a crowded stadium exit. The moment people get nervous, everyone tries to leave at once and it turns chaotic. But when the crowd realizes the danger wasn't what they thought, they stop running and suddenly the stampede ends. In markets, that looks like a hard flush followed by aggressive buying and a fast reclaim of key levels. Now, I want you to imagine how this looks inside a real trading desk, because this is where the move starts making sense. When silver is dropping rapidly, market makers widen spreads to protect themselves. Liquidity gets thinner. That means each new sell order pushes the price further than normal. It's not necessarily more sellers. It's fewer buyers willing to stand in front of the train. Then, once price hits a level where value buyers step in, or where shorts start taking profits, the dynamic flips. Buying into thin liquidity can be just as violent as selling into thin liquidity. That's how you get the snap rebound. Another amplifier is options positioning. You don't need to trade options to understand this. When price crosses major strike areas, market makers often hedge. Sometimes that hedging adds fuel to the move down, and sometimes it adds fuel to the reversal up. In fast markets, hedging flows can behave like a feedback loop. Price moves, hedges adjust, and that adjustment pushes price further. And then there's the psychological layer. Silver is the kind of market where people get trained to expect smash downs. So after a big drop, many traders instinctively short the bounce because they've seen dead cat bounces before. But if the bounce keeps going and price flips green, that's when the trap closes. Shorts who expected an easy continuation suddenly have to cover. Covering is buying, and buying into a thin market can make the rebound explode. That's why these moves can feel like the market is alive. It's not just price changing, it's positioning changing. Fast. Now let's talk about what it means for physical silver buyers in the US, because this is where a lot of viewers feel confused. You might see the screen price crash and think, great, I can buy cheaper. Then you check physical coins or bars and realize the price didn't drop the way you expected, or availability tightens, or premiums stay stubborn. And sometimes dealers even go call for pricing during chaos because the wholesale replacement price is moving too fast. That disconnect can feel unfair, but it's actually a clue. Physical markets don't reprice smoothly during whipsaws. Dealers protect themselves because if they sell too cheaply during a paper flush, they may not be able to replace inventory at those levels. So during a crash and rebound day, the question isn't only what is spot doing? The real question is, did physical loosen or did it stay tight? Because if physical stays tight while paper whipsaws, it suggests underlying demand is still there and the paper move was mainly liquidation noise. Now here's the part that keeps you safe from getting emotionally yanked around. A violent move doesn't automatically mean the squeeze is guaranteed or the banks are done or any dramatic one-liner like that. What it does mean is the market is stressed, and stress reveals weak points. In silver, weak points often show up as sudden liquidity gaps, rapid spread widening, aggressive stop runs, and then equally aggressive rebounds when the forced selling ends. So what just broke, realistically? Usually one of these things: a key technical level that had a lot of stops under it, a liquidity pocket where buyers stepped back, or a leveraged positioning imbalance where too many traders were leaning the same way. Sometimes it's also a macro catalyst, an unexpected move in the dollar, a surprise rates headline, a risk-off wave in stocks that hits metals fast. But even when there is a macro headline, the size of the move is usually explained by market structure, not by the headline itself. Here's a simple way to interpret a day like this without panicking. The crash is the stress test. The rebound is the result. If the rebound is weak and keeps failing, that can signal the market is still fragile and sellers still control the tape. But if the rebound is sharp, flips green and holds, that can signal the market just flushed out weak positioning and reset higher. Again, not a guarantee, but it's information. Now, I want to keep your curiosity going with one important point most people miss until after the move. Silver doesn't usually trend smoothly. It often moves in phases. First it's boring, then it's jumpy, then it's violent, and finally it becomes obvious to everyone, usually near the point where risk is highest. The boring phase builds positioning. The jumpy phase shakes people out. The violent phase forces repricing. That crash and rebound you just saw is often what the transition looks like between jumpy and violent. So what should you watch next, specifically, if you want to know whether this was just noise or something bigger? Watch how silver behaves after the adrenaline fades. If silver holds key levels over the next couple of sessions, that matters. If it immediately gives back the rebound and starts making lower lows again, that matters too. The market is telling you whether buyers are real or just short covering. Watch volatility. If volatility stays elevated, it means the market is still unstable and positioning is still being adjusted. Elevated volatility is where squeezes can accelerate, but it's also where fakeouts happen. This is why you don't want to make emotional decisions during the loudest hour. You want to watch the follow-through. Watch the dollar and yields. For a U.S. audience, these two often act like the weather system around precious metals. A sudden dollar spike or a sudden yield jump can pressure metals, even if the longer-term story is supportive. If the dollar calms down and silver still holds up, that's strength. If the dollar spikes again and silver collapses again, that tells you the market is still sensitive. Watch the physical signals, premiums, availability, and dealer spreads. If spot drops but physical doesn't get meaningfully cheaper, that often means physical demand is still firm or the supply chain is still tight. If dealers widen spreads dramatically, that's uncertainty. If dealers start limiting quantities or pausing pricing during spikes, that's another stress signal. And there's one reality check that is simple enough for anyone to use. After a big whipsaw, does the market return to normal quickly? Normal means spreads tighten, pricing stabilizes, and physical availability improves. If normal returns quickly, the event may have been mostly liquidation. If normal does not return, if spreads stay wide, premiums stay high, and pricing remains jumpy, then the system is still under pressure. Now, I want to be honest. It's tempting to see a move like this and immediately declare, this is the start of the end. But the smarter approach is to recognize what silver is good at, revealing stress early. Silver is small enough and leveraged enough that it can show the first cracks of a bigger shift, but it also loves to fake people out. That's why you watch the second and third day behavior, not only the first shock candle. This is also where the paper versus physical story becomes important. Paper can move violently because it's driven by positioning. Physical moves more slowly, but it reveals the true demand for metal when people actually need it. If paper collapses and physical stays sticky, that's the market telling you the flush didn't change the real-world supply-demand balance much. If paper collapses and physical also loosens quickly, then demand may actually be cooling. So what does this mean for squeeze pressure? Squeeze pressure rises when sellers are forced to buy back into strength. A crash and rebound can be a squeeze ingredient if it traps shorts and resets positioning. But squeeze pressure doesn't come from one candle. It comes from conditions stacking together: persistent physical tightness, repeated failed smashdowns, and price holding higher levels despite attempts to push it down. And that's the thing I want you to remember. The market tried to break confidence with that fast drop. The question is whether it succeeded. If If the rebound holds and buyers keep stepping in, then the attempt to break confidence may have backfired. If the rebound fades and sellers regain control, then the drop did what it was supposed to do: scare people out and reset lower. Now let's bring this back to you, watching from the US, trying to make sense of it without living on a trading screen. Your goal isn't to catch every tick. Your goal is to understand the environment. Is this a normal market or a stressed market? Normal markets don't do $10 swings and flip green like it's nothing. Stressed markets do. And stressed markets are where the biggest moves can begin, but also where the biggest mistakes happen if you react emotionally. So here's the calm way to think about it. If you're a long-term holder, these moves are mostly noise, unless they change the bigger trend. If you're a trader, these moves are opportunity, but also danger, because spreads and slippage are real. If you're a physical buyer, your real price includes premiums and availability, not just spot. And if you're just trying to learn, this is one of the best real-time lessons you can get. Markets don't move on fairness, they move on positioning and liquidity. Now I want to hear from you, because your experience helps everyone watching. In the comments, tell me what you saw today in the real world. Did physical premiums in your area drop with spot, or did they stay stubborn? Did your local dealers stay stocked, or did pricing get weird? And do you think this was a liquidation flush, or the kind of failed smashdown that can lead to a bigger move? If you found this breakdown helpful, please share it with one friend who follows silver, but gets confused when price action turns violent. Sharing helps the right people understand what's happening before the headlines get dramatic. And here's the final thought I want to leave you with. The most important part of a crash and rebound day isn't the crash. It's the moment the market tries to scare everyone out, and then fails. If silver can absorb a violent drop and still flip green, it's telling you something about demand, positioning, and stress under the surface. Don't get hypnotized by the candle. Watch what happens next. Because in silver, the biggest moves don't always start with a rally. Sometimes they start with a trap.